Let's talk technicals. Joining us now is Katie Stockton, founding and managing partner of Fairlead Strategies. I spoke to you last like a month ago, Katie, and at that point, things were looking a little toppy to you in the S&P in terms of complacency and bullishness and how extended it was above the moving averages. And then I think we went up another 6-7% until we saw this most recent pullback. Is that part? I mean, is that about as close as you can come to getting it exactly right in terms of you might see that something looks overbought, but you could still get another 7% before it happens? Are we still in that consolidating or downward move?
Yeah, I mean, I think so. I think sentiment was definitely the biggest risk to the market when we last talked. And now it's been relieved to some degree, but not to a great degree. So we've seen that overly bullish condition now sort of pull back with the broader market, but not to the degree of which the indicators are flashing an oversold reading. That word oversold is overused, but there is meaning to it, and we really just don't have that quite yet. So what I would assume is that the overbought downturns that we have seen over the past couple of weeks, and that's really primarily in the market leadership, names like Apple, that it will give way to not just this initial pullback, which of course has been quite sharp and severe, but also additional consolidation before we get that tradable low. And I think it's very constructive from an intermediate and long-term perspective. The market now is much, much different in a positive way than other strong tapes like back in the late 90s. I've heard a lot of people talk about, well, this is a bubble and now it's bursting. Not at all in the charts. I mean, what we're seeing is positive long-term momentum, but that's a new development. It's not something that's been in place for years like in the late 90s. So I think that we assume that this corrective period is constructive given the breakouts that preceded it.
I guess we're right about where we were when you were talking about a correction last time. I mean, so we're at 33.39. Are you would you be surprised to see 5 to 10% from here, or it moved up? And can we do the 5 or 10% from the when it was when it was up near 3,500?
Usually the pullbacks are worse in the first few days, and we had 3 days of about 7% downside for the S&P 500. So I don't think the losses will be so dramatic going forward. I do expect another downdraft next week, and I say that in part because of the VIX, which was one metric we were watching as a risk metric going into this. It was something that helped us trigger the pullback to our clients because it had cleared a resistance level of its own. It now is taking a pause that we think will give way to one more volatility spike, and that volatility spike could be enough to get those sentiment readings where we want them to be in terms of oversold or more bearish than we are currently. We're still pretty constructive, largely speaking, on the markets collectively. So I think we might need a little bit more downside. I think 5 to 7% is probably too aggressive for the S&P 500, but perhaps not too aggressive for some of the market leadership. If you do look at Apple, for one, initial support on that chart is around 100, and the stock is looking up this morning, 114, 115. So that's pretty dramatic downside. But if you were to see a pullback of that magnitude, it would really be constructive because it would help, one, allow buyers that felt like they missed it to add exposure at a better price, but it would maintain the uptrend. There would be no breakdown at that level, and it would be a successful test of support and really help refresh that uptrend.